Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and spending it with us. There is a lot going on, to say the least, over the last couple of weeks. A lot of things have changed since we last were together. A lot of questions being asked, a lot of questions on just how geopolitical events are shaping the way the markets are behaving, the ups, the downs, the volatility right across the board. We've seen a lot of it, whether it's in the oil sector, whether it's in the markets in general. A lot of questions investors have. And as always, we're going to hopefully answer as many of those questions as we can today on our show. So let's put up the list of ideas that we have for our show today. Our first segment, it's going to talk about markets in flux due to geopolitical events. What we mean by markets in flux? Well, markets really haven't gone anywhere really for the first half of this year. We're just starting to get onto the positive side of things in the U.S. Toronto Stock Exchange, a little bit better, a little bit more gains for the TSX. And a lot of that has to do with the components of the TSX, that being gold as a major component of the TSX. A lot of gold companies trade on the TSX. So that has helped the Toronto stock market perform a little better. So we're going to talk about markets in flux and what's happening with respect to the market's behavior. Top three things to consider over the next 5 to 10 business days. As always, popular part of our show where I hit on three ideas, three things investors need to keep an eye on going forward. The Fed's next steps. We know that Jerome Powell is testifying to Congress yesterday and today, up on the Hill, as they say, and answering as many questions as he can from all the different politicians, talking about, I guess, when they're going to cut rates, if they're going to cut rates, and or perhaps why the Fed hasn't cut rates at all as yet. So let's talk a bit about Fed's next steps and what their next steps or his next steps are going to depend on. Gold and oil, a bit more volatile as of late, to say the least. We've seen oil run all the way up into the mid to high 70s. That's WTI price per barrel. We've seen Brent crude, which is the European price for oil, move higher as well. And then there's obviously our oil prices here in Canada, Western Canadian Select Oil, and what that's done. Not to mention gold prices. We've seen a lot of gyrations in the gold price as well. We've seen markets or days where the price of gold fall $60, $70 an ounce, only to rise by that amount the following day. So we're going to talk about gold and oil. Also, two investment ideas I get asked about quite frequently, especially here from Canadian investors. Diversification. Is diversification working? We always say that you have to be diversified. You have to be diversified. I think everyone has heard that probably since they started investing recently, or perhaps even many years ago. But is a diverse portfolio or a diversified portfolio faring as well as perhaps one that isn't as diverse? Something to talk about for sure. Quick hits. These are three ideas that have been in the news as of late that I'm going to comment on. And perhaps I think we have an illustration for each of those as well. And last but definitely not least, your questions. We're going to hopefully get to a couple of your questions and that we get from the audience, either questions that came in during the show or questions that we've received since our last show. Always like to answer those questions on air. So promises to be a fantastic information-packed show. And so without further ado, let's move on with their show. So markets have definitely been, I guess, in flux, really not understanding, or investors not understanding exactly which way things can go. And I think there are a few reasons for that. Obviously, trade and trade negotiations between the United States and the rest of the world, that has caused a lot of angst, has caused a lot of, I guess, fear from investors, fear from different countries trying to make or negotiate a trade deal with the U.S. And that has really caused the markets to pull back initially, to surge forward when negotiations were announced. But now we're waiting to see if Canada, Mexico, European Union, China can come forth with a trade deal with the United States. We've heard some framework on a deal with China. We've heard about a deal being, looks like, about to be signed between the US and the UK, but nothing really here in Canada. We're hearing about a deal coming about in the next 30 days. But then when you hear our prime minister speaking, sometimes you think maybe a deal is actually not that close and it may take a little while. So trade has been one of the reasons why the market has sort of been on hold, gone up, come back down, to surge once again. Obviously, the events of the last couple of weeks between Israel and Iran in the Middle East, the war in the Middle East, that also has prevented this market or kept this market from surging higher. We've seen certain parts of the market like oil move and gold move with respect to events out of the Middle East. But overall, it's been trade, the war in the Middle East, on top of a bill that's trying to be passed by Congress in the US, the one big beautiful bill from the US, from the current president, who wants to put everything in a bill, extend tax cuts, amongst, well, I guess that would be the biggest thing in the bill, the tax cuts, trying to get this bill passed. But everybody knows this bill, if passed as is, would mean a lot of debt to the United States. So a lot of reasons why this market has been on hold or in flux. And our first chart here, which is the S&P 500 year to date, you can see in April, the big sag in the middle of the chart there. In April, when reciprocal tariffs were announced, obviously the market did not like that, and the market pulled back. But really, since then, we've seen the market move higher on I guess, a gradual basis. We've seen a lot of ups and downs, and these are other things. Obviously, towards the middle of June, we saw a bit of a pullback because of the war in the Middle East. We've seen at times different things take the market down and move back up. But for the most part, if you look at the second half of this chart, or the right side of this chart, from April to present day, it's been pretty steady, bottom left to the top right. But the reason why I say this market is still on hold is because if you look at the left side of the chart, we're just getting back to exactly where we were to start the year. We started the year in January, moved up in February. We hit our high, let's say, third week of Feb, and have since come down to sag in the middle and now surge in the second half, I guess, of the first 6 months, or I guess the point between middle of April and present day. So definitely markets have been up and down, just getting back to where they were at the start of the year. Our next chart is the S&P 500 over the last month or so. And you can see that just in the last month, the ups and downs that have occurred. Again, overall, the good news is the market has definitely gone from the bottom left to the top right. As I mentioned, this bill, this one big beautiful bill that is trying to be passed in Congress in the US, that's right now being stalled in the Senate, is talking about taking on, or the US taking on, a lot more debt. And that's probably the main reason why, or the main challenge to get this bill passed. They wanted to extend President Trump's tax cuts that he put into place in his first term, and they want to extend that now in his second term. But we know this is going to cause a lot, or increase the debt levels in the US. Our next chart clearly shows how much debt is being taken on in the US. Look at that chart. Oh my goodness. Look how steep that chart is. And that has just been in the last 15 years or so, how much debt has the US has taken on, how much debt the current president inherited, how much debt he added on to the total back in his first term as well. So federal debt held by public through Treasury securities has hit nearly 29 trillion. I think actually that is even higher now. I think that's 30 trillion. And we know, because of interest rates where they are in the US, there's a lot of interest being paid on debt. And that's one of the big reasons why the president of the United States, President Trump, has been so hard on the Federal Reserve and the head of the Fed, Jerome Powell. He wants him to cut interest rates so they can bring down those interest payments that the federal government is paying on current debt. Jerome Powell, I'm sure, would tell you, well, that's not the job of the Fed. That's the job of the government to decrease debt levels, and therefore you would pay less interest on the debt. So there's this back and forth between the Fed and the president. And we've heard some of the commentary hasn't been too flattering, to say the least, by President Trump with respect to Jerome Powell. Our next chart here is a great chart with respect to crude oil exports from Iran. And you can see here, the main takeaway is how much those crude exports initially, or I guess back between, between 2010 and 2020, how much those decreased. And then since 2020, how much they increased. And Iran has once again become a major player with respect to crude oil exports. And again, one of the reasons why this market was nervous, if something happened in Iran, if something would have happened, if Israel would have bombed or the United States would have bombed a refinery or some sort of energy producing facility, look how much oil would have been taken off the market. I think it's roughly 2 million barrels a day. And that is a lot. Now, yes, the other OPEC nations believe that they could have made up the slack. But nonetheless, the market definitely was nervous about that. And again, another reason why this market has been in a bit of a holding pattern. Not to mention the war itself, right? War is not good. Markets don't like war. Our next chart, I should say, shows this. The related market decline when you see a war. There you have the Korean War, a crisis, Cuban Missile Crisis, JFK assassination, a lot of negative effects, invasion of Iraq. A lot down the left-hand side, you could see the negativity there. But the good news is, and this is what keeps investors propping up the markets, is that everybody knows that shortly thereafter a war, perhaps 2 months later, 10 months later, you could clearly see that the market rebounds quite nicely. So on one hand, market doesn't like war, sells off initially, and then the savvy investor, the smart investor comes in shortly after, buys the dips, market goes right back up. So again, war, the one big beautiful bill, trade, this is what's kept the markets in flux for the most of the first half of 2025. The good news is we seem to be getting through these things, climbing that wall of worry as we move forward. And now, with at least a ceasefire in the Middle East, we now can hopefully, or at least the president of the United States can hopefully now get back to doing what they were doing prior to the war, which is negotiate, hopefully negotiate some trade deals with the rest of the world. Canada in particular would be fantastic, but China is also important for stock market, for technology stocks. So the hope, or at least my hope, is that we can move on from the war in the Middle East back to these trade negotiations. And the hope is that they can come to some resolution with regards to these trade negotiations, and we could see this market moving forward once again. Now the part of our show that I get asked probably most about, which is the top 3 things that individual investors need to keep an eye on before you make your investment decisions. We always seem to have economic data on the list. We recently received inflation data in Canada. CPI was reported, Consumer Price Index, and PCE, which is the preferred, data by the Fed. PCE, Personal Consumptions and Expenditures. This data will be coming out this Friday. Again, very good indication as to how inflation is going in the U.S. And we already had the numbers out of Canada with regards to inflation. We saw tick higher in core inflation, but our headline number came in as expected and as many were anticipating. Trim gains and buy lows. This is what I've been doing for a lot of investors. I'm going to show you when we were buyers, and now on some names we are trimming some of those profits and moving that money to buy companies that are at low points once again. That will be next month's or perhaps in the future, winners to come. Number 3 point that I wanted to touch on for individual investors to consider: interest rates on GICs and bonds. They're not much of an option anymore. Perhaps TINA, T-I-N-A, the acronym TINA, there is no alternative. Perhaps that has come back into play and causing, or one of the main reasons causing this market to move higher. So let's move on with the first point, which is economic data, CPI and PCE. As I mentioned, headline CPI in Canada, 1.7%, and came in as expected. When you take core inflation, less food and energy, also remained a little bit elevated than a little bit more elevated than expected in the high twos, getting close to 3%. Not the way I think Bank of Canada wants to see it go. It'd rather go in the opposite direction. At the end of the week, we're going to get information or data on PCE, US inflation numbers, and it's going to be a big number. A lot of people will be looking at this number. I'm sure the President of the United States will be looking at this number. If it's a low number, I'm sure he will be putting more pressure on the Federal Reserve to cut rates. Jerome Powell and the Fed as a whole will be looking at this number as well to talk about when the next cut will be. So let's take a look at our first chart. Bank of Canada, key interest rate versus inflation. There you have it. Our inflation rate right now coming in at 1.7%. A policy rate coming in at 2.75. That is the Bank of Canada is key interest rate versus the inflation rate. So again, you have about a 1 percentage point difference between the Bank of Canada rate and the inflation rate. Many people believe that inflation rate will start to go higher in the coming months. Our next chart, Canada CPI versus core CPI. And you can see there it's getting closer to 3% again, 2.6. And you can see the headline number there at 1.7. Is it moving higher? Well, I think you can see the headline is kind of stable, but definitely the core number is on the way up, which again, Bank of Canada does not want to see. Next chart, U.S. Consumer Price Index, 2.8% as a core reading, 2.4% as a headline number. And I guess to me, the number is obviously important, but it's the slope of the curve, right? And really, you're not seeing much increase in the data right now. Again, one of the reasons why many are calling for the Fed to cut rates, because inflation is just not moving higher as yet. And I know Jerome Powell in his recent meeting has said that he believes that they will see significantly higher inflation in the coming months due to the tariffs that are placed on goods coming into the United States, and perhaps tariffs that may be put back on goods coming into the United States if trade deals are not made. Our next chart here is PCE. You can see PCE data. 2.5% is when you exclude volatile food and energy, and 2.1%. So pretty much at the Federal Reserve's target rate. And again, low inflation, not seeing it go up. In fact, you could argue that it's actually come down since the last reading. So this reading on Friday of PCE will be extremely important to the markets. If we see a big bump or a rise, I think the Federal Reserve or Jerome Powell will have a big smile on his face. One of those days where I think he would want to say, I told you so. But if the rate is still low and doesn't move higher or actually moves even lower, perhaps it's the President of the United States will have a smile on his face and continue to put pressure on the Fed to cut rates. So this week, big for inflation data. We already received Canadian data, and on Friday, we will receive US data as well. The next point I wanted to touch on for individual investors to focus on before they make their investment decisions is this whole idea about where are we in the cycle, right? Are we at the highs, the lows in the market? Obviously, for those of you that follow the market, we are back at all-time highs right across the board, whether it's Toronto, whether it's New York, NASDAQ, Dow, S&P 500. We are at pretty much all-time highs once again, or just off all-time highs, I think less than 1% in some cases. So what I wanted to show and talk about today is how I think about buying individual stocks at this point. You know, back a few months ago, middle of April, when we saw, well, as we just showed, the S&P 500 charts, markets sold off substantially, we were a buyer. You know, I was buying things on the cheap. and we even spoke about it on our shows. Now, I'm still a buyer. I think you're always a buyer into this market. You can never time markets. But not only am I trying to buy things, obviously, at a low price with good value, and if they pay dividends, even better, but I've been a trimmer of some of the profits. And so wanted to show a couple of charts which will clearly illustrate how I think and how I think individual investors should be thinking when you decide whether to sell or whether to buy an investment idea. Our first chart is Broadcom. We can pull it up here. Now, this is a one-year chart, or sorry, a year-to-date chart. And you can see the sag again, like a lot of the charts I've shown you already, sag in the middle, that is back around middle of April. So clearly, middle of April, stock was trading at around $150 a share. There you have it. You're not going to be trimming the stock at those levels, but you probably would be a buyer because the stock was much higher prior to that in the 250 range. So at 150, how can you not be a buyer of Broadcom? A fantastic diversified company, obviously, or I should say recently, getting a lot of praise for its AI chips, its custom chips. And that's probably been the biggest reason for the stock to move higher prior to April, and probably the biggest reason for it moving back up recently. So I went from a buyer in April to a trimmer, someone who trims some of the profits, take a little bit off the table. We may not want to let everything ride on one name like this. The prices are pretty high. Valuations have gotten higher. Maybe you take some profit off the table. Now, I think I would be foolish to tell you Broadcom is not going to go higher from here. So a lot of investors say, well, why are you selling it if you still think it's going higher? Well, it's all about risk management, right? You want to take some risk off the table. You want to sell some, but keep some in, because I do believe over time this name can continue to move higher. I just want to reduce the risk by trimming some of the profits. Our next chart, we have another chart of Broadcom, and you can see just in 1 month alone how much the stock has moved up. And I would say in the last month, that is when I've begun trimming some of the profits for some investors, if it makes sense with respect to the weighting in their portfolio. So, if you're someone looking today and you're thinking, should I be taking some of the profits in Broadcom? The answer is perhaps. We have to take it on a client or investor by investor basis. And we have to see, how much of a Broadcom do you have in the portfolio? What is it? What's the percentage that it makes up of each portfolio? So there's a lot that goes into it, not just, trimming profit. You want to take a look at where that stock fits in the whole scheme of the whole portfolio. The next stock I'm going to show you, it's Celestica. Now, you're going to notice that Celestica says $145. And for all you savvy investors out there, you're probably thinking Celestica is a lot higher than that. And it is in Canadian dollars. And this is actually Celestica in US dollars. But it will still show what I want to show, which is like Broadcom, Celestica, very much an AI play in the Canadian space, electronics manufacturer in Canada as well. Very big tech name, probably them and Shopify are two biggest. So Celestica pulled back in April, probably would have been a great idea to buy on the cheap if you had the stomach to buy, because as we know, a lot of people, when stocks pull back, you may not be so confident to buy. As it started to move higher, and Canadian dollars, it's approaching $200 a share once again. Perhaps you start trimming back some of the profits and leaving a good position in the portfolio, but take some profit off the table. Once again, we have a chart on Celestica, our next chart, which shows the 1 month gains. And again, like Broadcom, Celestica has been on a fantastic run, exceptionally higher. Our third chart, I think our last chart in this segment, or this part of our top three, is one on JP Morgan. JP Morgan has moved also higher. You can also see the sag again in April. That would be for pretty much every stock, I would think, especially growth stocks or stocks that are purchased for growth. And once again, you're probably trimming back some of the gains in the last month or so as JP Morgan has moved significantly higher. So what I wanted to get across as my point is you want to trim some of your winners, take some profit off the table at this time. I think that's the prudent thing to do. Use that money to buy into investments that have not moved higher as yet, that you think will be tomorrow's winners. So take money from yesterday's winners, to add money to investments that are still good value, and lower for tomorrow's winners. Sell high to buy low, or buy low to eventually sell high. Something that we all have heard many, many times. Our third point that I wanted to get across to individual investors is this idea about fixed income. A lot of individual investors talk about asset classes such as stocks or bonds, GICs, gold, etc. And one of the things I've noticed, once again, and I mentioned off the top of the show, are that GICs and bonds just, unfortunately, just don't cut it right now. If you're looking to grow your portfolio, GICs from your big top 5 or 6 major banks, right now, they're paying somewhere between, let's call it generously, 2.5%, 3%. You might be able to get something between 3.5%. And so to me, that just doesn't work. If you have to pay half of that to tax or a portion of that to tax, then you subtract the inflation rate, the real rate of return on that investment, it could even be negative, which I will show you in just a moment. Our first chart is a chart on 1 and 5 year GICs. You can see here clearly how they're following each other and how they're pretty much at the same level. So the market's not paying you more for a 5 year as they are compared to what you're getting on a 1 year. That when we say that the yield curve is relatively flat. It has steepened a little bit in the last 6 to 12 months, but definitely we would like to see this steepen a lot more. Our next chart, which I alluded to just a moment ago, is the real rate of return of GICs, real rate of return of a GIC. And I guess for our purposes, you can see here in the gold, how many times that gold line falls below the break-even mark. So that's the 1 year GIC, a real rate of return after tax and inflation. You can see the dark line is a 1 year GIC returns, and the blue is after you pay tax, and they just arbitrarily use a 40% marginal tax rate. And then you can see the gold is basically the return after tax and inflation. So all of you that are out there right now that are sitting on bonds and GICs, yeah, they're great for protection. There's no doubt about that. You know, most people buy these products for the low risk aspect. They know that they're not going to fluctuate an awful lot. But the reality is, unfortunately, you're just not going to make an awful lot as well. Our last chart here we can show is a chart which shows what interest rates are for Government of Canada bonds. And you can see there, that's what I was talking about. You're talking a 1 to 3 year. You're talking, in that 2.6, 2.7 range. 3 to 5 year, a little bit higher. 5 to 10 and over 10, you're getting, in that 3.5 range. So is taking a 1 year versus a 10 year worth it? Getting 3.6 versus 2.6 or 7 to get that 1%, you got to tie your money up for 10 years? Probably not. And so to me, right now, TINA does apply. I don't think individual investors, when they're getting 2-3% before tax and inflation, just not enough to grow your wealth and grow your portfolio. So keep that in mind as well when you are considering your investment decisions, along with the economic data that will be released at the end of the week, the economic data that was already released earlier, and this idea of, don't let it all ride. Trim some of those profits. It's the prudent thing to do. I'm not saying to try and time markets, but as your investment moves higher, I think it's always a good idea to take some profit off the table. So Fed next steps, we've already spoken about the pressure that I think the Federal Reserve is under, pressure that has been put on the Fed by President Trump. He wants to see interest rates cut significantly. If you compare the Fed to what they're doing in Europe, Europe has cut interest rates a number of times already. We here in Canada have cut rates a few more times in the US. It's the US that seems to be not wanting to cut. They seem to continue to take a wait and see approach. However, I will say that perhaps the Fed is starting to warm up to the idea of cutting rates. And for most of the Federal Reserve governors, they do this dot plot. So they basically indicate where they stand, all the different Federal Reserve members, they indicate where or what they believe will happen between now and the rest of the year, how many Fed cuts they expect, and most of them are still saying one or two. So I think you may see some Fed rate cuts in the second half. And some of the quotes by some of our Federal Reserve governors are clearly stating this. We have a couple of quotes that were recently made. Governor Waller was quoted recently, and we can put up his quote right now. There you have it. If you're starting to worry about the downside risk to the labor market, move now. Don't wait. Why do we want to wait until we actually see a crash before cutting rates? So I'm all in favor of saying maybe we should start thinking about cutting the policy rate at the next meeting, because we don't want to wait until the job market tanks before we start cutting the policy rate. So that's what he was saying. Now, keep in mind, he's talking about jobs going soft, and we're seeing that in the US. We're hearing a lot of companies. I think off the top of my head, Microsoft has announced a bunch of job cuts. They're the latest one, or the last one that I heard of, cutting jobs, and they've been cutting actually on a frequent or regular basis. Not to mention some of the other big S&P 500, Fortune 500 companies that are cutting jobs, whether it's because of artificial intelligence taking those jobs and replacing people, or whether it's just a slowing economy. And many believe it's most of the job cuts are due to a slowing economy. Our next quote here is one from Michelle Bowman, and she just said this recently: should inflation pressures remain contained, I would support lowering the policy rate as soon as our next meeting in order to bring it closer to its neutral setting and to sustain a healthy labor market. So once again, talking about the labor market, talking about they believe that the labor market and a softness in labor is what they're focusing on more so than the inflation rate and price stability, because price stability doesn't really seem to be, there's not really a problem with price stability right now. We're not seeing inflation move higher in the US as yet. On our side here in Canada, we've seen core CPI moving a little bit higher. So many believe that perhaps Bank of Canada, where they once thought they would be cutting next meeting, now we're hearing rumblings that maybe the Bank of Canada does not cut if inflation continues to show strength and move higher. Our next chart here, Fed rate cut expectations. This is something that came out of CBS News. Federal Reserve to make next interest rate decision. There you have it. They believe that there would be 3 cuts, perhaps a half a point. That was a survey by CBS. Half a point followed by 2 quarter-point cuts towards the end of the year. I have not heard of that aggressive of a reduction in rates. I've heard 2 cuts, and I was anticipating 2 quarter-point cuts, so 50 basis points, maybe between 50 and 100 basis points. But to talk about the rate cuts at least 1 full percentage point, that may be a little bit higher than the Fed is talking. Our next chart here, I think, is a fantastic chart. This is the Fed funds rate versus the S&P 500. So you can see, and I want to just point out a few things. When the Fed funds rate goes higher, and probably the best one would be the last time. So in 2022, we talk about this on the show all the time, Fed raised rates, I think it was 11 times. You can see the blue line on the far right-hand side, not the last bit, but let's say somewhere around 2022, if you can look at that, you see the markets fall. And if you look at certain points in time, 2000, markets fall, rates went up. You can see, let's say late, maybe 2007, 8, markets fell. We had a financial crisis. We had interest rates running up into that crisis. And then obviously rates were cut basically to zero, where they were until maybe 2016, 17, and you saw the markets rise. So there's definitely a relationship between interest rates, the Fed funds rate, and the stock market performance. And so what does that mean? Well, if you believe that the Fed is going to cut rates, if the Bank of Canada is going to continue to cut rates, then this market should move higher based on historical values and what's happened obviously in the past. Our next couple of charts show U.S. jobs and employment. Unemployment rate seasonally adjusted. It's been pretty flat in the U.S. You can see that's on the left side. Non-farm payrolls, month over month change. Yes, it's come down, but still, well over 100,000. Number in and around 135, 150,000. That's where the employment numbers have been. We have a next chart on Canadian employment change, and you can see we're sort of flatlining it here. Nothing, no major change there. So overall, it is the mandate for the Federal Reserve. It's that dual mandate, jobs. It is the dual mandate of looking at price stability that the Fed is going to look at before their next move. And clearly, Jerome Powell does not want to be pressured and will not be pressured into cutting rates too soon. He wants to see the data. He says he's data dependent. The Federal Reserve, as a governing body, says they're data dependent. And we'll have to see come Friday just exactly what the data tells us. Gold and oil, yes, they have been moving very quite volatile. They've been moving very much so, a lot, depending on what's going on in the world, whether it's a war in the Middle East, whether it's that chaos that we've had in the markets with respect to trade negotiations, trade deals, tariffs, trying to cut taxes in the U.S., you name it, we've seen it pretty much all happen in the first half of this year. And yes, it affects the U.S. economy. It affects the U.S. dollar more so. And as we know, price of gold, price of oil, definitely affected by the U.S. dollar. Gold more so than oil, although they're both priced, WTI obviously, in U.S. dollars. And you can clearly see here, we'll show our first chart on WTI. So this would be, actually, sorry, we're going to show our gold first. My apologies. We're going to show our gold chart here, and you can see how gold has fared in the past month. When we started to hear that trade negotiations were happening, then we are started to see on the left side of this chart, the price of gold start to fall. When we started to hear a bit of chaos with respect to trade, gold prices go up. We had obviously a war in the Middle East. Gold prices spiked. That was beginning of June, or say mid-June. And since then, there seems to be now a calm. Obviously, we have a ceasefire right now. It's still holding. No one seems to be wanting to go against that. And that ceasefire has been, I guess, a good thing for the markets, for the U.S. dollar strength, gold weakness, U.S. economy, as well as stock markets around the world benefiting from a stable, I guess, geopolitical situation, stability in the Middle East, and that just brings the markets higher. So we've seen gold really fall off by quite a bit in the last, let's call it, few weeks. Our next chart is on oil. I jumped the gun a little bit there. Our next chart, WTI crude. And again, you can see how much of a premium was built into the price of WTI, or oil per barrel. It's hard to always guess how much of a premium is built in because of the war, but you can clearly see oil getting above or in and around $75 and now pulling back to in and around the low 60s, $64. And as I've said on our show many times, I would not be surprised to see oil prices fall below 60 once again. There's a lot of energy, a lot of oil out there in the world. OPEC continues to produce at a higher level. U.S. is producing over 13.5 million barrels a day. There never, or I guess there never was, or there doesn't look to be in the future, a slowdown by Iran or some of the other OPEC nations. The Straits of Hormuz, where 20% of the world's oil flows through that strait, that little narrow piece of water that is in the Middle East area, that Iran could easily try to put a barricade there to stop oil from flowing. It never happened. And even though I guess they scared everybody by threatening to do it, they never actually did it. And oil has been flowing ever since and getting to where it needs to get to, places like India and China and all over the world. Our next chart is Brent crude. So this is the price of oil in Europe, and very similar chart to the chart of WTI. You can see it spiking higher because of the war and coming straight down once things started to calm down. So as I've mentioned many times on our show, as I mentioned on BNN, when I was on BNN recently, if you are a person that is investing in gold, investing in oil, I think you need to keep one eye on the yellow metal or the price of oil, but the other eye on what's going on in the U.S. If the U.S. can now, they negotiated a ceasefire in the Middle East. If they can get some trade deals done, U.S. China, U.S. Canada, U.S. Mexico, if they can get a trade deal done with the EU. So if they can do that, I believe U.S. economy, U.S. stock market will move higher, U.S. dollar will move higher. Not good for the price of gold, as an example. If they can get through, and I think they will, in some form, there's big, beautiful bill through Congress. Once again, I think that's a good thing for the U.S. dollar, for the U.S. stock market, for the Canadian stock market, but not good for the price of gold. So if you own gold today, I think you should have a one finger on the sell button, because you may want to take some of that profit if we should see some a positive situation with respect to trade negotiations in the United States. And last, obviously, the price of oil. As we see production ramp up again, OPEC nations, the United States continues to ramp up production. I think the price of oil will continue to fall. And I think that is what President of the United States wants to see to combat, or at least fight against, a rise in inflation. Diversification. The headline says, is it working? Well, I'm going to tell you it always works. Diversification is the cheapest way to protect someone's portfolio. You don't want to have all your eggs in one basket. We've heard that term or that saying for many, many years. However, there are certain points in time, in my opinion, where certain parts of the market, and we've seen it over the last few years, such as technology, have outperformed pretty much everything else. You can make the argument that gold has outperformed tech this year, and that's quite possible, but we'll see what happens by year end. I still believe the price of gold is going to fall, whereas I also believe tech and tech sector is going to surge even further ahead. So technology, part of a diverse portfolio, but at certain times, I believe it is a good idea to perhaps overweight a certain part of the economy, of the markets. And right now, I think if you're an investor that has overweighted slightly technology, or perhaps overweighted that part of the market significantly, you'd be in the driver's seat, because technology continues to drive the bus forward. It continues to lead this market further and further ahead. And there is no doubt about that. I know a lot of people have spoken about the S&P 500 equal weight. We talked about this on the show before, but it's technology, make no mistake about it, that has earned a lot more than all the other sectors of the market. The Mag 7, Magnificent 7 stocks, earnings tripled what the other 493 stocks have done in terms of it's gone up over 27%. We have a chart on that in a moment, versus the rest of the 493 stocks on the S&P 500. Let's go to our first illustration. This clearly will show you the NASDAQ 100. So these are your biggest tech names, how they fared versus the S&P 500 equal weight, which means if you just took the NASDAQ 100, compared it to an index like the S&P 500, but if the index was equal weighted, right now we know the S&P 500 is overweight tech, but if we equal weighted everything, what would be the difference in growth? And you can see the NASDAQ 100 has significantly outperformed pretty much everything else, including technology, if you equal weighted everything. So this makes the case to overweight technology. Now, once again, you have to be careful, because you don't want to have too many eggs in one basket. We have seen points in time where technology has pulled back when the rest of the market hasn't. So it's not like you're immune to all volatility if you own technology, but we all know that this is where the growth is. In our second illustration, we've seen this diagram or chart before on a previous broadcast of our show, but this will show you, there it is, how much the Magnificent 7, just the Mag 7, not even tech as a whole, just the top of the biggest 7 names have outperformed. And you can see here on an earnings per share growth basis for the first quarter, year over year, 27.7% growth versus 9.4% growth. So this is what I mean when I say tech. Now, I know I'm going to get a lot of questions from clients and investors saying, are you saying we should not diversify? No, I am saying you need to still diversify. But there is nothing wrong if you want to overweight certain parts of a portfolio. Perhaps you want to overweight certain names in a portfolio, certain investment ideas in a portfolio. There's nothing wrong with doing that, as long as the rest of your portfolio obviously is nicely diversified. In a market in certain times, you may want to put a little bit more in an area where you think that it will have outperformance. So I'm not saying not to diversify. All I'm saying is just be mindful of what's working today and what parts of the stock market and what sectors are clearly outperforming the others. Quick hits. This is the part of the show where I talk about three things very quickly that I've seen in the news today. Well, not today, but over the last couple of weeks. And some of this, I'm sure many of you would recognize. First one, Canada signs a new security and defense pact with the European Union. Very important. We're now starting to see Canada start to look elsewhere for trade negotiations, for pacts, for ideas, places to ship our goods and services to, not just relying 70 or greater percent on the United States. Number two, Canada ranks amongst the least literate countries in the world in terms of AI. I found that shocking because I know many people in Canada, many businesses taking on AI and incorporating AI into their business models. And all I hear is people raving about how AI has changed the way they do business, has changed the way businesses function. So AI going into a business and turning around, making it more efficient. So I find it hard to believe, but we have a chart or we have some commentary that shows this. And our third quick hit, Trump pressures Congress on his big, beautiful bill as debate clouds the path forward. It's just the whole idea of the president wanting his bill, his tax cuts to go through, and Congress saying, really, we have a problem with the debt levels. So those are the three things I wanted to comment on. Let's go to our first one. Canada signs a new security and defense pact with the European Union. This was something that I'm sure Prime Minister Carney wants to see more of, this idea of doing business, more business with other countries, and defense spending and is obviously security. Defense spending is something that I think more and more countries we know are spending on. We're just hearing now all the countries that make up that NATO, they're talking about spending as much as 5% of their GDP on defense. And that's, I guess, music to President Trump's ears. We have our first chart talking about defense spending. You can see all the different countries there. You can see Canada. Well, we're doing about just under 1.4%. I think the big takeaway here is if you look at where things were and how much they've gone up. So the dark line is where things sit right now. And the light blue line is 2014. So you can see countries are definitely spending a lot more on defense. Events like what happened in the Middle East will definitely cause people to spend more. Events between Russia and Ukraine. So a lot of European countries looking to spend more, which is driving their economy. Spending more definitely drives their economy. Whenever government spends more, if they have the money to spend and they don't take on a lot of debt, that can help drive the economy. Our second quick hit, Canada ranks amongst the least AI literate countries in the world. Again, ChatGPT. I know a lot of you have heard of ChatGPT and all the other types of AI that many of us are using right now. Our first illustration, or only illustration here, you can see Canada is lagging behind global peers. And I think it's just more of this unknown. People are a little nervous about it. They have questions about it. So you can see on the far left, 34% are willing to trust AI. The next circle there, 79% are concerned about positive, negative outcomes of AI. 92% are not aware of any laws that apply to AI in Canada. And 75% believe that AI regulation is needed. And I think we're going to see more and more of that as time goes on. Here you have a quote from KPMG right underneath. As we navigate AI, organizations must acknowledge Canadians' concerns, especially around cybersecurity, privacy, and unclear regulations. While there's apprehension, there's also hope that AI can deliver real benefits. It's up to organizational leaders to address these concerns and engage the workforce through transformation. So I think it is known that we need to incorporate AI more and more into the way we work and do business. And hopefully we can educate those that need to be educated on AI. Our last quick hit, Trump continues to pressure Congress to get his one big beautiful bill passed. And interesting thing is that you have a very mixed, I guess, feeling towards his one big beautiful bill. And as you can imagine, that mix goes along party lines, right? Our first and only chart here, I think it's our only chart here. You can see the party lines. It's unfavorable by 64% versus 35%. The Democrats overwhelmingly unfavorable, 85%. Whereas you look at Republicans, they come in at 61% in favor. MAGA supporters, so all those supporters of Make America Great Again, Donald Trump supporters, President Trump supporters, 72% are in favor, and non-MAGA supporters, 66% are unfavorable towards the one big beautiful bill. So we'll have to see how things play out. In my opinion, I think the bill will be passed, just not in its current state. I think there's going to be some give and take on both sides, but we definitely will get a reduction in taxes in the US. The question is just how much. Another part of our show where I try to take on at least one question from the audience that I've received during our show or over the last couple of weeks. And here's one here, which is a bit of a different question, which I haven't spoken about. As home ownership is getting less affordable, this investor is focused on growing my savings by investing in the market. How important do you think it is to have your property as part of your investment mix? I think it's a great question. I think living here in the GTA, if you've had a house here for a number of years, you've probably made off pretty well with your real estate investment. I know a lot of individuals that incorporate real estate as part of a diversified portfolio to work towards your retirement. Some people invest, some people own condominiums or own homes that they rent to individuals as part of their overall income that they take in, rental income. I actually know someone who has many properties that he uses and for saving for retirement. And his comment was, down the road when I need some money to retire, I'll just sell a few of my properties. So yes, real estate can be and should be, if you can, a very large part of a investment portfolio. If you're living and owning a house today, I think that is really many of our fallback, right? We all know at some point we'll have to probably downsize. If you have children and they leave the house, you're going to sell your home, downsize, live somewhere smaller, and hopefully make some money when you sell your house, and your new property probably, or place that you're living, won't be as costly. And that's when you can live off, obviously, the money of the sale of your home, not to mention living off your investments as well. So I guess my answer is, I think it's a mix of both things: real estate investments as well as investments in your retirement savings, RRSPs, TFSAs, and the whole lot. With that, I want to say thank you once again for everybody who joined and watched our show this afternoon. As you all know, I will be back 2 weeks from today. I believe, yes, Wednesday, July 9th. Wow, it'll already be Wednesday, July the 9th on our next show. So almost, I guess, just past the midway point in the year, right in the thick of things for summer. Hopefully the weather will cooperate with all of us and we can all have a great summer holiday as well. But hopefully all of you can tune in at that time in 2 weeks, same time, 12 noon. And until then, happy investing.